What's going on, guys? Welcome back to the channel. Welcome back to another video. It's Ron here. Hope you guys are doing very well today. Just wanted to give a quick shout out to everyone who has messaged me and sent me questions and emails regarding investing in real estate, the stock market, what's going on with the Federal Reserve's latest decision with interest rates and how it's going to affect the stock market and the housing market. And so with that being said, I want to talk to you guys about a couple of things. Number one, we did hear from Bank of America making a very bold prediction indicating that, basically Bank of America is expecting a test of the stock market, the S&P 500, to test the all-time highs later this year. So that's a very good sign. But we've also heard from a number of different investment bankers and economists that are not quite as optimistic as Bank of America is. In addition to that, many people are benefiting from ETF passive income streams through dividend payments that are paid out. And we have already heard from Home Depot reporting probably one of the worst earnings reports in the last nearly 2 decades. With that being said, there are some areas of exposure that I want to warn you guys about. Now, this is not financial advice. I am not a financial advisor. I'm not a tax advisor. Always seek your own counsel from a financial and tax standpoint, and always do your own homework, do your own due diligence. Now, me personally, I have my favorite ETFs. I'm probably never going to just sell out of my favorite Vanguard VOO S&P 500 tracking ETF, as well as many other staple ETFs in my investment portfolio. But based on what we're seeing with the Fed, and based on the decisions that the Fed has made and what we expect the Fed to be doing in the coming months, specifically June, July, August timeframe, I think that there are some areas that we should be very wary about. Right now, commercial real estate. Predictions of a real estate market housing crash, particularly in commercial real estate, is getting really, it's starting to pick up. And I think that the writing is on the wall, and the writing has been on the wall for a while, but I think a lot of people have kind of ignored it, thinking it might just be a trend, and maybe it is a trend, but I think it's certainly starting to pick up speed here. Now, commercial real estate, this includes office space, industrial space, retail space, medical space, special purpose buildings. I don't know if commercial real estate might include apartment buildings. I don't know if that's considered technically, because it's residential, but it's, I don't know if we'll include that. But certainly hotels, warehouses and the like. So this is pretty much what commercial real estate is, right? So you also have to keep in consideration that, what is the value of commercial real estate and how is it driven? Well, you need to understand that the commercial real estate value is driven by the income that the property generates. So commercial real estate, it's a lot different than residential real estate in terms of how it is determined how much is worth, right? So generally speaking, with real estate, or residential real estate, you would likely go to an appraiser and they'll look at your property in detail, measure its size, identify whatever its amenities are, square footage, number of bedrooms, bathrooms, improvements, lot size, and location, and compare it to nearby homes that have sold recently. Well, commercial real estate is determined or valued a lot different than how a residential property or residential piece of real estate is valued. With commercial real estate, they're going to look at how much income the commercial real estate can generate. So the income will be based on how much a property can charge a commercial tenant to rent that space or lease that space. And based on those numbers and based on the expenses associated with the overhead of maintaining that property, a value would be assessed for that commercial real estate. Now, as we have seen over the last 2 to 3 years, there's been a decreased demand and need for commercial real estate space, such as office buildings, some industrial spaces, some retail spaces. We've heard of, Walmart shutting down certain locations in many different states. Bed Bath & Beyond is closing a number of different retail stores, if not all of their Bed Bath & Beyond retail stores, special purpose buildings and the like, right? So we've seen quite a bit of pullback in the commercial real estate space. So we need to be aware of what's happening. And a lot of this has to do with what the Fed is doing with interest rates. Now, as interest rates continue to be manipulated by the Federal Reserve, namely mortgage rates, and making mortgages much more expensive, it is also, because mortgage rates are so much more expensive, it's making commercial real estate values decline, because if the mortgage associated with the commercial real estate is higher, then that means that the profitability of that piece of commercial real estate would be reduced. Basically, if your expenses go up and your income from the property goes down, then obviously your profitability is going to be negatively impacted. So basically, you're getting hit from both sides. So this is the first thing that I wanted to cover with you guys, right? Now, commercial real estate loans, they also have like a much shorter time frame. I mean, usually commercial real estate loans, you might get a loan for as long as maybe 20 years. But if you compare that to a residential property, you can usually get, you obviously can do 15-year loans on residential. You can probably do 20-year loans, though I don't hear 20-year loans on residential very often. But usually the most popular loans for residential properties is 15 years and 30 years, right? Some people do ARMs, or adjustable rate mortgages, which I'm really against those, especially now. And in fact, I don't know if I've ever been on board with an adjustable rate mortgage. But what most people do is they'll take a 15 or 30-year fixed rate mortgage, and that way they can kind of control their living expenses a lot more. Versus if you have an adjustable rate mortgage, pretty much every time Fed Chair Jerome Powell wakes up on the wrong side of the bed and decides to raise interest rates, your mortgage rate would likely be affected. Now, the banks are considering commercial real estate as a much more risky asset compared to residential real estate, which is why you usually can't get a loan for commercial real estate for as long of a duration as you can with residential. With that being said, there are some things that we should be taking a look at and we should be prepared for, right? One of the methods of passive income that I'm a huge fan of are earning dividends from ETFs on the stock market, right? But I wanted to share with you guys some commercial real estate ETFs that are on the stock market that you should be aware of, so that you can look into these ETFs to see if these have too much exposure to commercial real estate, or maybe some of these ETFs are great buying opportunities either now or later in the future. I'm going to leave that judgment up to you in terms of when you should get in, when you should get out. But I think we should at least talk about some of the commercial real estate ETFs that are out there to see, hey, maybe I own one of these. I'm just thinking, if sometimes people make investments and they don't even know what they're buying, right? So maybe you say to yourself, hey, I didn't even realize that this had a lot of commercial real estate in it. Maybe you need to look into it. Maybe you should, maybe if you're not aware of it, maybe you might even consider whether it's worth investing in the future as we get more clarity and certainty in terms of the commercial real estate market. So let's talk about the Invesco S&P 500 equal weight real estate ETF. This one is ticker symbol EWRE. Then we also have iShares Cohen & Steers REIT, or Real Estate Investment Trust ETF. This is ticker symbol ICF. There's iShares Core US REIT ETF, ticker symbol USRT. You got First Trust S&P REIT Index Fund, ticker symbol FRI. And there is iShares US Real Estate ETF, ticker symbol IYR. Now, there are many other ETFs out there with commercial real estate exposure, but these were some of the top commercial real estate ETFs that I came across that I figured, okay, let me at least highlight these, just kind of bring them up. Maybe these offer some good buying opportunities. Maybe these are some ETFs that are maybe not necessarily buying opportunities now, but maybe present themselves as buying opportunities in the future. Again, do your own due diligence, do your own homework. This is not financial advice or anything like that. So now, how is this going to impact residential real estate? Do I need to sell everything tomorrow? Do I need to put my house on the market? I think that everyone needs to make their own decision in terms of whether or not you should put your house on the market or whether or not you should be buying a house that's currently listed in the housing market, right? But I think that there is a big difference between commercial real estate and residential real estate right now, right? So first of all, residential real estate is really separate from commercial real estate, and I don't see how commercial real estate is going to directly negatively impact residential real estate. So at least if commercial real estate crashes, blows up, and explodes, residential real estate should be almost unaffected by that. Now, to the extent that it would be affected, or to the extent that residential real estate would be affected, I'm thinking, okay, maybe, you know, the local economy might be affected by some commercial real estate being shut down. Because if commercial real estate shut down, then chances are there's some job loss in that local economy. But I'm just speaking like from a national standpoint, I don't see how residential would pose a tremendous amount of risk in the event that commercial real estate were to just, you know, kind of have a significant crash. The other thing is that there's a tremendous difference in the supply and demand for residential real estate compared to commercial. Now, with residential real estate, a lot of people have predicted huge housing market crashes, and we just really haven't seen that. And so this is a good thing for many homeowners who purchase homes during the pandemic, pre-pandemic. Chances are you're in a good space, especially if you have an interest rate on your mortgage that's less than 4%. Even better if you're less than 3%, right? So the difference, though, a big difference here is that with residential real estate, the demand is still quite high for it, and the supply is quite low still. So even though the demand has pulled back with increased interest rates thanks to the Fed's raising of interest rates, the demand is still greater than the available supply on the market for residential real estate. So the values are still holding up pretty well, considering the fact that interest rates have literally doubled in less than a year and a half. So I think that that's a tremendous feat and a tremendous argument for why real estate values are pretty freaking legit. So very good sign there. Also, rents, the rental market is still very strong. There hasn't been any type of tremendous pullback in rent prices. So residential real estate is actually looking very attractive right now, especially compared to commercial real estate. Now, you know, obviously some markets experience massive post-pandemic surges in demand, and certain areas are starting to cool off, like Las Vegas has cooled off quite a bit. Florida is still strong. California has pulled back quite a bit. Certain parts, and that's what I've always been taught. You know, my mentors have always taught me that real estate's always local. One area could be declining in value. Another area, you know, 10 miles away might be increasing in value, right? But you got certain areas of California that have really seen a decline, such as San Francisco. San Francisco has seen a decline in their real estate values. But again, you know, if you're in it for the long term, chances are you'll be just fine. And history has proven this, right? You know, higher interest rates have, you know, it's basic economy. Higher interest rates have made getting approved for mortgages more difficult. Well, it doesn't really make getting approved for mortgages more difficult. It just makes it difficult to get approved for a higher amount, because your ability to get approved is based on your debt to income ratio and how much of a monthly mortgage payment you can afford. So if the interest rate has gone up, it increases how much your mortgage rate's going to be. And so this will decrease how much of a mortgage you can get approved for. So, you know, that's how that's being affected. But, you know, sellers with fixed rate mortgages, most of these sellers are not in any kind of hurry to sell their house, to sell their real estate, whether it's a rental property or their primary residence. They would rather just wait for better market conditions, because these sellers know if they sell their house today, they're not going to get that 3% interest rate on a 30-year fixed rate mortgage in this environment. The Fed has blocked that. Those days are gone. So, you know, any homeowner right now that was even thinking about selling has decided to take their home off the market and decided to sit it out, unless they really have to sell, or they're planning to sell the property and purchase the new home with cash. Then interest rates are irrelevant. So, you know, that's my take on this one, guys. But I just want to always encourage you guys to always pursue financial freedom. But in your pursuit, be aware of the changing economic dynamics, the market dynamics, because no market is static. Everything is always changing. And we as investors and the Fed and what they're doing in Washington, D.C. and the banks, we all have a role that we play in our economy, and our collective actions dictate what happens in the future. So we need to be aware of what everyone's doing. And that's why I love giving you guys these updates and helping to provide motivation and encouragement. So what am I doing today? I'm still investing in the stock market. I'm still looking for deals in the stock market, investing in ETFs, index funds, and basically my investment strategy has not changed. I continue to dollar cost average into my favorite investment accounts. And you should, don't necessarily use the same investment accounts I'm using. Pick the ones that you're comfortable with, right? But I would make sure I have an emergency fund of at least 3 to 6 months. Ideally start targeting a year. That's what I would do. Index funds, ETFs, your favorite online brokers, M1 Finance, Fidelity, Webull, Moomoo, whoever you like to use, Vanguard. And I'm just staying the course. I'm staying the course, dollar cost averaging. So drop me some comments down below, guys. Let me know what your goals are. Let me know if you're seeing something odd, something weird in the market. And if you would disagree with anything that I've said, I'd love to hear from you as well. Anyway, appreciate you guys hanging out with me. You should see a video here and here. Definitely check out those videos. Drop me some likes if you made it this far in this video. Also consider subscribing to the channel, and I will catch you guys on the next one. Y'all be safe.